What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Ryan Pulis here with another episode of the CPA Zone. Today, I'm going to introduce a topic of the Section 721 exchange. We're just going to cover this at a high level. It can be a bit of a complex transaction, so as always, you want to be sure you're working with professionals. And then at the end, I'm going to answer a few questions that have come up recently. I think I'll start adding this to the end of each episode. I'll just address a question or two that I've come across since the prior episode, and we'll tackle those on the podcast. So let's start with this 721 exchange. So all 721 exchange is, it's actually refers to the section of the Internal Revenue Code, and it allows for the tax-free exchange of property when it's contributed to a partnership. So it works similar to a 1031 exchange, where it's going to defer any capital gains or depreciation recapture on real property. You don't have to use real property in a 721 exchange. However, in practice, that's typically what we see when we're referring to a 721 exchange. Now, Section 721 just refers to general partnership law and applies anytime a partner makes a contribution of property to a partnership. But when we say 721 exchange, typically what we're talking about is the transaction that involves real estate, and it's a way to defer taxes similar to a 1031 exchange. So let's go ahead and just read Section 721 and see what the IRS says. So Section 721 says, no gain or loss shall be recognized to the partnership or any of its partners in the case of a contribution of property to the partnership in exchange for an interest in the partnership. So basically what that's saying is you can donate property, especially appreciated property, to a partnership in exchange for your ownership interest in that partnership, and it doesn't trigger any taxes. So it's not treated like a sale. So in that sense, it works just like a 1031. So remember, with the 1031 exchange, that allows you to exchange real estate for real estate on a tax-deferred basis, meaning you don't pay any capital gains or depreciation recapture as long as you follow all the 1031 rules. Now, 1031, you have to use a qualified intermediary. You have the 45-day rule, which says from 45 days from the time you sell your property, you have to identify generally up to 3 properties as the replacement property. And then there's a 180-day rule, which also starts the time you sell your property. And it says you have 180 days to actually close the transaction in order to achieve the tax-deferred results, and paying no capital gains or depreciation recapture. So those are the standard rules with the 1031. Also, keep it totally tax-free. You generally have to trade up in value. With a 721, you don't have those timing rules. There's no qualified intermediary to deal with. You're contributing property to a partnership in exchange for an interest in that partnership. So remember, with 1031, you have to trade real estate for real estate. You cannot 1031 into a partnership interest, or at least it's very difficult to do, and you have to use something called like a drop and swap, or you actually go to a tenancy in common. It gets pretty difficult. 721 avoids all the headaches. You simply contribute your property to a fund, which is set up as a partnership, typically an LLC, and you recognize no taxable gains. You defer the tax on your capital gains and depreciation recapture. Typically, you'll see this most often referred to, or you'll see this commonly referred to as an UPREIT, U-P-R-E-I-T, because investors will use this strategy to swap their property into a fund, and in exchange, they receive shares in a real estate investment trust. So typically, the REIT, the R-E-I-T, is structured in a manner where there's an operating partnership. The fund, that's what you're going to contribute your property to. Now, if the REIT doesn't want your property, you may need to do something a bit more roundabout. So you might need to do 1031 into something like a Delaware statutory trust or some other property that the REIT would accept, and then from there eventually swap for shares of the REIT. So it can get to be a bit complex. Again, as always, make sure you're working with professionals. You aren't required to go into a REIT. That just happens to be the most common play that we see surrounding this 721 exchange. So you could just simply create your own partnership. So for example, let's say you and two friends, you each have an investment property, and you think, why don't we diversify our risks and put them all together? We create a partnership, you can contribute each of your properties to the partnership, diversify your risk, and now you're all owners of the partnership. That would not be a taxable event, it's tax-free. Now all three properties are owned by you and your two partners, and the properties are owned by the partnership that you created. That would work as well. That is also considered a 721 exchange. Now, your basis in whatever property you contribute to the partnership carries over from the actual property contributed. So you defer the gain now, you don't pay any taxes, but in the future, when you go to sell, if you would sell your interest in that partnership, your gain is going to be calculated starting with that initial rollover basis. It works just like a 1031 exchange. So the 1031 exchange, you exchange into a new property, your depreciable basis starts with the old carryover basis. When you eventually sell, all those built-in gains become recognized at the point of sale. Now, with a 1031 exchange, you can do something that's referred to as swap till you drop. You 1031 into bigger and bigger properties, and eventually when you die, your heirs get a step up in basis. The same would apply to the 721 exchange. If you hold it until you die, your heirs can receive your interest with that step up in basis. So works just like a 1031 again in that respect. Now, as I mentioned, the 721 transactions, very complex. Make sure you're working with a professional. So we just touched on it on a high level today, something for you to be aware of that's out there. It is a tool to work with. If that's something you're interested in, be happy to talk to you about that if you want to reach out to our office. So now let's just touch on a few questions I've received in the last couple weeks. One involved a short-term rental. So the question is, do I really need bookings for my short-term rental? I bought it at the end of the year. We're getting ready to file our tax return. I planned to use it as a short-term rental. Bought it in December, didn't have any customer stays. When we started using it, it became a short-term rental. Unfortunately, the answer to this is yes, you have to have customer stays before the end of the year to treat it as a short-term rental. And remember, we like the short-term rental because for passive loss rules, a short-term rental is where the average customer stays are 7 days or less, gets you out of that. It was technically not a rental for the passive activity loss rules, so you don't have to be a real estate professional to deduct your losses. All you need to do is demonstrate material participation. However, if you don't have any customer stays, you can't calculate an average of 7 days or less. So the courts in 2022 decided, or they clarified, I should say, that you cannot treat something as a short-term rental when you don't have any actual customer stays. That court case was Rogerson v. Commissioner, Tax Court Memo 2022-49. This confirms you have to have customer activity to calculate the average. Without it, it's impossible to establish the average period of customer use, which is required by the regulations. Now, personally, at our firm, and I know many other real estate tax CPAs say the same thing, you should have at least 2 customer stays to calculate an average if you want to do it safely. Now, nothing in the regulations specify it has to be at least 2. In fact, the more the better. But if you're going to try it with 1, there's a good chance you could end up in tax court and have to prove why 1 is sufficient to calculate an average. And as everyone probably knows, going to tax court is very expensive. So you don't want to be the trailblazer. Try to go for the 2 stays. Make sure you get at least 2. And the second question that came up, client had a partnership deal, short-term rental, partnership, performed a cost segregation study, used accelerated depreciation. They wanted to know, how does depreciation and the losses produced by the bonus depreciation in the cost seg study work if only one partner in the partnership is materially participating? Well, in that case, only the partner with material participation is going to be eligible to deduct those losses. The other partners are passive. The activity to them is a passive activity. They will not be able to deduct their losses. And in fact, if you have a partnership, unless all partners are working or participating at least 500 hours or more, if they're showing material participation that way, generally only one partner is going to qualify anyway, because you're not going to qualify under the substantially all test if all partners are somewhat active. And the other test that's most common, or that's particularly common for material participation, is 100 hours and not less than anyone else. Typically, so let's say you have a partnership with 3 people, if all 3 partners are doing some form of participation showing 100 hours and not less than anyone else, it's going to be very difficult for more than one partner to qualify if you're very closely tracking time and making sure everyone participates the exact same number of hours. I guess in that case, you could have a tie, but that's going to look a bit strange, although it's technically possible. So again, if everyone's participating more than 500 hours, then no problem, all materially participating, you can all deduct your losses. If not, odds are only one partner is going to qualify anyway. And if only one partner is materially participating, then obviously only that partner is going to qualify to deduct their losses in this case. So that about does it for today. I appreciate you listening. I hope you found value in this episode. If you did, please hit that like and subscribe button. Leave us a 5-star review. Until next time, have a great day. Thank you. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.